European high-yield bonds the bond market is a fixed interest rate market. So it means that when rates will increase for companies when they will refinance. And as you know, they have refinanced a lot in 21. But for now, I would say the new issues have been relatively limited. So the refinancing needs have been relatively low so far. So that's why we don't see the full impact of higher rates compared to loans, for example. And if you look at the typical European high-yield index, we'll see that the weighted average cost of debt have increased by around 50 bips. And if you compare to the 5-year bond, for example, it has increased by around 3%. So it means that the impact of higher rates will be felt gradually by European high-yield bonds, and it's true for loans that have taken into account the full impact of higher short-term rates. So that's the difference.
What does the supply outlook look like? I think you mentioned just right at the beginning of that first answer that there hasn't been a lot of supply coming to the market. Why is that? Why are companies postponing issuing bonds? Is it a function of their cash needs, or is it a reflection of the environment that we're in?
There are, I would say, both of that. First of all, the refinancing needs were relatively limited because, as I said, in 21, we had a lot of new issues. So a lot of companies have already extended their maturities and refinanced a lot. So it's the first thing. The second thing is also that strong, maybe double B companies prefer to wait if they can afford to. They are not in a hurry to issue at higher levels. And that's why we see we don't see a lot of new issues. If you look at the gross supply, it's already above last year at above 30 billion. But in net terms, it's near zero or even slightly negative to take into account coupon payments. That explains. This is a positive technical for now for the market because when supply is limited, it's tend to support the secondary market. But I think that over the maturity wall is in 2026. So between now and 26, of course, we'll see more and more needs for refinancing.
Marina, bearing in mind that 2026 is when the real maturity wall will become a potential issue, what do you think of valuations in this space right now? Do you think spreads look attractive in high yield?
In high yield, the spreads is around 450 right now. It has already tightened by around 50 bips year to date. So it has, I would say, it's very strong performance, especially considering the macro context. So it's difficult to see spread tighten significantly over the coming months, especially if we expect also inflation to remain sticky, for example. And but what we can say for high yield is that the all-in yield is particularly attractive right now. Not the spread. The spreads are not reflecting a recession scenario. And by the way, it's not our scenario. Our best case is a slow growth scenario, not a recession. But clearly, there is not a lot of room for tightening, I would say, at this level.